Hi, I'm going to give you an update on the RECM Equity Fund and talk about the third quarter in particular, give you some sort of highlights of the actions within the fund, the performance of the fund over the quarter, and also just give you a little bit of detail with regards to how the fund is positioned going forwards. So this last quarter was a pretty flat one for the South African equity market overall, but within the South African equity market you did have sectors performing very strongly, and in particular I'm referring there to the resources sector. You'll know that this fund is quite heavily exposed to that sector, and as a result the fund performed very well. It actually was up 11.5% for the quarter relative to the market, which was flat. So year to date that actually brings the equity fund's performance to just shy of 37%, which I think just gives some indication of a bit of a turnaround in the value sort of style, and the market starting to favor that style relative to perhaps styles which are more momentum or growth oriented. And we hope, of course, that that will continue. We're certainly seeing, we believe, a turning of the tide in that respect. So looking at the actions over the quarter, as you might expect, with the discount to fair values narrowing, we pulled back some of that resources exposure. In particular, we reduced our exposure to stocks such as Amplats, Implats, Anglo American, which have all featured quite strongly in the portfolio over the last few years. We also pulled back our exposure to some of the stocks in the construction sector. Now, that's also a sector that has been under a lot of pressure, certainly since the World Cup, with a lot of excess capacity in the industry, and we've started increasing our exposure to that sector sort of over the last sort of 6 months to a year, very, very slowly, and we now have exposure to WBHO, Robix, and stocks such as Invicta, who are related to construction, as well as Avenge. Now, with a very strong rally in those stocks over the last quarter, in fact, the index pertaining to that sector was up about 11% during the third quarter. We've trimmed our exposure to those stocks as well. We saw some price weakness in some of the higher quality businesses which feature in the fund, and there I'm referring to luxury business Richemont, and we took advantage of that to actually increase our exposure. And there that's largely a result of Rand strength, obviously that being very much a Rand hedge business. And we also increased, for the same reason, our exposure to business such as Sasol, and then also MTN as well, which has also come off a bit on further sort of bad news coming out of Nigeria. So looking at the overall positioning of the fund as a whole, if you look at the top 10 stocks, you can see that there are still quite a few resources names featuring there. Obviously, in particular, I'm referring to Impala Platinum, you've got BHP Billiton, you've got Anglo American, Anglo Platinum, and Glencore Xstrata, still all in the top 10. But increasingly, as those stocks rally, we are pulling that back, and the portfolio has become a lot more diversified than it was 2 years ago, which is always a good thing. And the market has really allowed us to sort of broaden the exposure in the portfolio. And in particular, you'll see that there is still quite a bit of cash in the portfolio, looking at the sort of equity cash split, which does indicate that it's the higher quality businesses which are a little bit more expensive. The value opportunities are still on the lower quality side of the scale, and as a result of us sort of taking a smaller position in lower quality businesses, trading at a similar discount to fair value as we would for a higher quality business, that does translate into a component of cash which is left for us to use still. That's not a bad thing, with markets being quite volatile at the moment. We are getting opportunities to deploy that cash into some good businesses which are starting to become cheap. And I think overall, what you're left with is a portfolio which is well diversified. It's very much tilted towards the undervalued, underpriced stocks in the South African equity market. Remember that as smaller investors, we have the full opportunity set to take advantage of in South Africa. So that cash is going to come in very handy when those opportunities become available amongst the smaller businesses in particular. And we do believe that the tide is turning. I think this year to date has shown that things are shifting, and we think that value investors who remain patient will be handsomely rewarded for doing so. Thank you.